Good morning, everybody. Hey, it is John Lone King, and today is Friday, the 26th of September. Thank you for joining me. It has been an action-packed month, and it is going to continue next month. So let's go ahead and dive in. First and foremost, I don't want to say I told you so. I hate that the fact that this is one of an I told you so situations, but the Fed has not been our friend, and we can't count on the Fed to be our friend. This Fed is determined to clearly not make the mistake that they made before about inflation. They are determined to make sure that they don't underestimate the power of inflation. And I understand where they're coming from. And the truth is, Jerome Powell is determined not to let Donald Trump look like he's won. And everything that the Fed is doing is pushing to say, we are not sure rates are going to go down as quick as you think. Deja vu, said it last week. It's exactly the same as what happened last year, but I want to help you understand exactly what's going on. We're in a position right now where the Fed has put in writing that they expect rate cuts to be coming, but every word that's come out of their mouths has simply said the opposite, that, hey, rate cuts are not guaranteed. And that's spooking the market. And we're seeing interest rates climb literally every single day, like what we've seen in at this exact time last year. That's created kind of a whiplash in the bond market. And so I want to talk to you a little bit on the technical side today, a little bit about what we're seeing and what history shows us. And so I'm going to share my screen right now, and I'm going to show you, is that the version I want? That's not what I want. That'll work. But, oh, well, that won't work. All right. Anyway, let me put on my old person glasses. So this will show you basically what is going on. I think there's a better version. Why did I not like that one? Anyway, whatever. Yeah, that's the best one I got. I don't like that one. All right, fine. So let's dive in. Here's what we're looking at right now. Right now, the 10-year Treasury. 10-year Treasury is really the benchmark of how to look at mortgage rates, because mortgage rates don't follow what the Fed does. The Fed controls money borrowed overnight. The 10-year Treasury controls money that is borrowed for a 10-year period of time. Most mortgages pay off in less than 10 years. So mortgages follow the 10-year Treasury pretty close. Not exact, but pretty close. And what we're seeing right now is the low point that we hit on the 10-year Treasury was back on like the 8th of September, and it's been moving up here. This is a weekly chart. So we're seeing the 8th of September, 15th of September, it goes up some more. And here we are right now as of the 22nd of September. It's moved up, and then here we are at the 26th. Okay, so we're seeing the 10-year Treasury move up. We hit its lows literally the day the Federal Reserve did their announcement. Again, this is a long-term chart. This thing's going back a couple of years. So you only see once a week on a point. But what's my point? My point is this big red line right here. If you notice, as you look at how rates have bounced, and I'm going to actually go way back here to September of 2022, and we saw rates climb, and they touched this red line. They barely crossed over it, and then they came down, and they hit the purple line, and they bounced back up to the red line, and now they moved lower. And they stayed lower below the purple line. The purple line, by the way, is about 3.994% on the 10-year Treasury. They stayed below the purple line all the way until June of 2023, and they bounced above it, but then they went below. And this is called, it tried to break through. Like rates went up, and it tried to break through, and it said, nah, not really. And then it went up, and it kept going. And once it breaks through convincingly what's called a line of resistance, it keeps going. And it went straight through to the next line. And then it bounced back down, and it said, I don't know. This is a new line of resistance. This red line has historical implications. Rates like to fall in a certain pattern. And if you haven't noticed that, it's really important to understand. You see rates kind of range between a certain amount of interest on the high end and the low end, and then they break through it. But once they break through, they typically stay below until they break through higher or break through lower, and they move to the next band. So what I'm teaching right now is about the bands. And this red line right here has been a critical band. This is going back to 2023, August of 2023, and we're above that in higher interest rates all the way until November of 23. We come way down and we bounce off that red line. And then we go below it and we stay below it all the way until February 24. So you see how important this red line is. Here we are in March of 24, and we stay above it until July. Then we're below it from July all the way until October of 24. You guys see the patterns here. Here we've basically from October of 24, we were never below this red line except a quick minute in December. So this is last year. This is the key that I want you to understand. This is where we were last year when the Fed made the same announcement. So we started out with higher rates in July of 2024, very much like we started out with higher interest rates here in July of 2025. And we saw rates drop in July of 2025. Between the end of July and when the Fed met, rates fell very significantly right here. Okay. And we saw exactly the same thing in July of 2024. So we have rates that have come down from right here, July of 2024. They fell way below until September, and then they shot up once the Fed met. This is what we're dealing with right now. They shot up and they kind of leveled off right at the end of September, and then they shot up more. Well, here's what we're seeing right now. They shot up. They're kind of leveling off. It's critical whether we go higher than this or not will make a huge difference to where rates go in the next month. So if we see the 10-year Treasury go above 4.19 approximately, all bets are off. Because every time we've broken above that number, we might have quickly come back down, but we stayed above for a long time. So if we can hold this line of resistance is what it's called. If we can hold that line right where we are right now and rates don't go any higher, we got a good chance of a decent October. Okay, but this is critical, and the Fed is basically doing everything they can to convince the markets rates aren't coming down, and the markets are testing this line of resistance. All right, that's it for my technical side. I have a comment. Let's see what my comment is. Okie dokie says, I had an agent say they'd be increasing the price of a home we were going to offer on since the Fed will be cutting soon. Greed is going to catch up with a lot of these sellers and agents. I totally agree with you. I think that people misunderstand the market. They misunderstand and think that the Fed dropping interest rates means mortgage rates are going down. They are not. We have seen mortgage rates go up in the last 10 days since the Fed made their announcement, and I'm concerned we're going to keep seeing that. Last year, I feel the same as last year. Last year, a week after the Fed, I'm like, okay, well, they've gone up some, but they really aren't going to go up much higher. And then they kept going higher, and they kept going higher, and they kept going higher all the way until the end of October. I hope to gosh that doesn't happen. But the big key is going to be what the reports look like and what the Fed says over the next couple of weeks and a month to come. So here's what we're looking at. We're looking at, well, I just talked about it, the 10-year Treasury being a tipping point. We're at a very, very critical tipping point right now, and history is not our friend. So I am very concerned if you are in a position right now where you're thinking about, hey, I've got to lock in interest rate, and I'm not sure what my options are or what the best advice is. Right now, the market's pushing towards higher interest rates again. And people are misunderstanding that, but that is absolutely the direction that it's going. So do not listen to people who are saying, hey, the Fed's going to drop interest rates, therefore mortgage rates are going to fall. Mortgage rates already fell a lot in anticipation of what the Fed was going to do. And now the Fed is kind of pulling back a little bit from the way that they said they were going to drop interest rates. So a couple of thoughts on what this means. First of all, for people who are refinancing, be very careful. There are so many lenders out there who are trying to bait and switch you. They're trying to get you started saying they can offer a certain rate, but they won't lock you in, okay? Or they're packing in a significant amount of fees when they lock you in, and it doesn't make it worth doing a loan. It makes the interest rate look good, but it doesn't make it worth doing a loan. That's kind of my concern about what your rate is versus the reality of the scenario. They might be offering you a super low interest rate, but they're charging you a huge amount of fees. Now, on a purchase, you see those fees, you feel those fees because they come out of your pocket. But on a refinance, they bury them into the loan amount. They say, don't worry. You don't have to worry about the fees. All of those are being included in your new loan, and you're still saving $300 a month. That may be true, but you just added $30,000 to the price of the amount of your loan, and you extended back out to a new 30-year term. That is likely not the smartest idea for most people. So be very, very cautious about that. As far as purchasing, I'll tell you, I am seeing a surge in first-time home buyers looking for down payment assistance loans. Dream for All obviously is a big part of that. We had a huge number of people a month ago that got vouchers for Dream for All. The next round of Dream for All hopefully will be announced soon, and we're hopeful, I'm hopeful, that we're going to see the lottery opening up sometime early next year for people who want to get into the Dream for All program. But even if it's not Dream for All, I'm having more and more conversations from first-time home buyers right now, and that's a really good sign for the health of the markets. And a lot of people are thinking, hey, maybe now is the time to buy. And that's driving a little bit, and Okie dokie said this earlier in a different way, but it's driving a little bit of the multiple offer situations coming back. I am not seeing huge numbers of offers like we used to see. I'm also not seeing in a lot of markets that buyers are getting away with what they got away with a month or two ago. So we're seeing a lot of back and forth in this market. Now, I think there's one argument that says sellers are being greedy, like Okie Dokie said. The other argument is there's more buyers coming back into the market. And so we want to be cautiously optimistic, but we're in a delicate balancing act between where are interest rates going, where are house prices going. If you are buying a home, it's about finding the right home. You can't time the market. You can't time the perfect price of the home where the house prices go up and down. You can't time the perfect timing for interest rates and where interest rates are at. And so what you need to be focused on is, hey, do I have the right strategy? Do I have the right home? Do I have the right property available for me to purchase? And then pull the trigger and make it happen. Okay. I will tell you, there are some buyer-friendly markets that still exist out there. So this is not everywhere, but I'm seeing a lot of mixed emotions or mixed reactions across the board. What I will tell you really quickly is next week is huge, absolutely huge. Next Friday is the monthly jobs report. So the non-farm payroll report comes out 5:30 in the morning Pacific time, first Friday of every month. So next Friday, we're going to get the jobs report on the 3rd. That is the one the Fed is now saying they're paying the most attention to. That is the report that 2 months ago on the first Friday of August changed everything. And I said 2 months ago, rates are going to be on sale for the next 45 days. They were. Then they came off sale. Now they're coming back up again. Now we're still as good as we were back at the end of August, which is better than we were at the beginning of August. But if we follow the same pattern we did a year ago, we're going to be in way worse shape a month from now. But it's all going to depend on next Friday. The Fed will tell you they're worried about inflation still. I get it, but inflation is a known fact. What isn't a known fact is what is happening with the jobs market. It is shifting under our feet. And the Fed is saying, yeah, we're more concerned about the job market than we were before. We're leaning a little bit more towards the center of being concerned about both of our mandates, which is to keep prices stable. That's about inflation. And to keep employment fully employed, keeping everybody who wants to work having a job. So that's about unemployment report. And they're saying, hey, we've only been focused on pricing, on inflation. And now we're starting to say maybe unemployment is going to become a problem. So we need to shift our focus a little bit more this direction. They're not wholly focusing on unemployment, but they are saying that we're no longer wholly focusing on inflation. But if unemployment becomes a non-issue, their shift goes completely back to unemployment and rates go up. So this report next week is critical, especially because the Fed changed the definition of normal unemployment numbers. It's called job creation. How many jobs are created each month is how they define it on the non-farm payroll report. So the job creation number had been a few hundred thousand jobs created per month. And then over the last 60 days, the numbers dropped to tens of thousands, maybe between 30 and 70,000 jobs created a month compared to 3 to 4 times that previously earlier this year. Well, the Fed just came out last week and said, you know what? Jobs being created at a pace of 0 jobs created to 50,000 jobs created, that's the new norm. Well, they just took the wind out of our sails. That's part of why rates are going up, because the Fed's saying, I was worried about the jobs, and I really wanted jobs to be this good. But now that they're down here, well, maybe I'm just going to say this is normal now. And I'm not really worried about it, even if they're at this level. That basically resets our thoughts on what the Fed is going to do or need to see in jobs to take action in lowering interest rates. All right, I got a couple of comments here. Let's see if I can get to those. All right, Jeremiah said, we noticed good homes are still getting a lot of multiple offers. The first home we offered on went 10% above asking. That is a perfect example. So I'm seeing it in different markets. Congratulations on getting an offer accepted on a home, Jeremiah. But yeah, you're right. Like good homes and good priced homes. So to the point that Okie Dokie said earlier, I'll bring it back up right now, is the sellers that are getting greedy, that are raising their prices, they're not likely to get the multiple offers. But a well-priced home, a good home, you are absolutely seeing multiple offers, and you can't get away with, I'm just going to offer whatever and ask for a whole bunch of closing cost credits. You can still get closing costs, but you have to be strategic. All right. Leo says, I got an appraisal value of $770,000 for a $600,000 asking while on escrow a year ago. How long should I plan to refinance, and will I be able to take my PMA off? That's a great question. All right. So Fannie Mae says we can use current market value for a refinance immediately after buying the property. There is no waiting period. There used to be. It's urban legend to say that there is. Matter of fact, I thought so just a couple of weeks ago, and I was emailing my head underwriter saying, how long do I have to wait to use the actual fair market value after purchase. And she's like, John, where have you been? That hasn't been a rule for a while. So Leo, you can refinance now. Now, whether you should or not is the question, but you can. Now, the issue that you're looking at is you're saying, when can I take off my PMI? Taking off your PMI is a different thing. You can refinance and take off your PMI, and nobody can stop you from doing that. But taking off your PMI because of a higher value than what you bought the house for, you've got to have at least 3 years on the mortgage. So it's the HOPA, Homeowners Equity Protection Act. Wow, it's pretty good. HOPA, that was passed years ago. Don't remember the year. And HOPA outlines the rules of when lenders must remove your mortgage insurance. And it says if you pay down your balance to less than 80% of the home value, then they have to get rid of it immediately. No, not home value, of original purchase price. So if you pay down your balance to less than 80% of your original purchase price, they have to get rid of your mortgage insurance immediately, provided you've paid on time for the last year and provided that you don't have any second loans on the property, which is a key thing. Because a lot of people with Dream for All loans and down payment assistance loans, you're saying, hey, John, I can refinance and get rid of my mortgage insurance. You can't. You can refinance, but you can't just get rid of your mortgage insurance by paying down your balance, because even if you pay down your balance, you have a second. When you have a second, they don't have to get rid of your mortgage insurance. So Leo, in your case, you for sure can refinance and get rid of your mortgage insurance. But if you want to get rid of it simply because, hey, I've got a lot of equity in the property, they don't look at increase in equity or even increase over what you bought it for until you've owned it for 3 years. Honestly, it might be 2, but it's not 1. It's either 2 or 3 years, and I feel like it is 3. Anyway, the fact is the only way to get rid of your mortgage insurance right now is to refinance. Now, I don't know what rate you got a year ago. You're going to have fees when you're refinancing. So that's a question of, does it make sense? But at the time of refinancing, is you can get rid of your mortgage insurance because the new loan won't require it, given the fact that your value is 770, assuming it appraises for 770 now. I would also be concerned about that. I have multiple clients I've been talking to who have evidence that their property values have dropped, especially if you bought new construction. New construction, the builders were previously keeping their prices high by giving incentives and bigger incentives and bigger incentives, but they kept their price high. And in the last few months, I've seen a lot of builders say, okay, that's not working anymore, but I got to sell the home, and they lowered the price. I had a client call me about 3 weeks ago and said that they did a Dream for All loan on their property, and they had to move, and there was something outside of their control, and they had to move. And we were talking about their options, and they said, well, I said, what do you think the house is worth? And they said, well, we bought it for this amount, and the builder's now selling the same home for about $80,000 less. And I said, that's a problem. That's a problem because you're now upside down. And it put them in a really, really tough position. Now, Leo, I know you're not talking about selling, but refinancing, if that home, especially if it was new construction, that value might not be there because the builders have dropped values in a lot of cases. Now, hopefully that's not the case for you, but I would be cautious because when you refinance, you absolutely have to do a new appraisal. All right. So October 3rd, jobs report. That's the really big date. If you are in the process of trying to do a loan, you're thinking about, hey, when do I lock? October 3rd is next Friday is a hugely important date. Now, will it mean rates go down? Maybe. Will it mean rates go up? Maybe. But it means that it's a big, 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 big market mover. If the jobs report comes in with negative job creation, in other words, jobs lost. If we lost jobs, then we're going to see interest rates come down, because that is more evidence the Fed is going to start lowering interest rates. More, that they're going to lower interest rates more than they're already planning on lowering them. Remember, the market, the bond market, the mortgage market's predicting what the Fed's going to do. Once we know that's what they're going to do, that's built into rates. And it's only if they change their mind, like they're doing now, where we wholly expected them to keep lowering rates, and instead they're saying, I'm not so sure. Well, the jobs report is what's going to make them so sure. So if that jobs report comes in with 0 to 50,000 jobs created, it's going to be neutral. If you have more than 50,000 jobs created next Friday, rates are going up, because it means everybody's going to expect the Fed is not going to keep lowering interest rates. And as a matter of fact, may not lower interest rates at the end of October when they meet. So that's going to cause rates to go up. So do you want to take that risk? Is the risk worth the reward? Is the juice worth the squeeze? Do you want to worry and wonder what's going to happen with interest rates, whether you lock on Thursday or wait until Friday afternoon or Monday of the week after to lock? That's a pretty big what if. And so the question is it worth it to you, or do you take where you're at right now and just lock it in and not have to worry about it? That's the approach a lot of my clients are taking because there's just too many unknowns. Guys, I really appreciate you joining me. I want to make sure to remind you, you need to have the right advisor, and I'm interviewing to be that advisor. So scan this QR code, schedule a time to talk with me. I am looking forward to guiding you, giving you specific strategic advice to help you, whether you are a first-time home buyer, a seasoned investor, or somebody who just has some questions about how to get into the market, or you want to refinance your property. I would love the opportunity to take great care of you, and I look forward to talking to you guys soon. Have an absolutely wonderful weekend, and we'll talk to y'all soon. Bye-bye.